Welcome to the DIY Investing YouTube channel. Today we are using QuickFS to do a quick 5-minute overview of Activision Blizzard. I'm working through the entire S&P 500. Don't forget to like this video and subscribe to the channel to get the full series as I play it out. So let's dive in. This is my first 5 minutes of due diligence on a stock. So what I want to know first, so this is Activision Blizzard, ticker ATVI. What I want to know first is the industry and business type so that I can discover if it's a high quality business. So this is in the entertainment industry. You have a very big mix in that industry. So Activision Blizzard says that it develops and publishes interactive entertainment content and services in America, Europe, Middle East, Africa, or Asia. So it's worldwide. They have Activision Publishing, Blizzard Entertainment, and King Digital Entertainment. So it distributes content and services on video game consoles, PCs, and mobile devices, including subscription, full game, and in-game sales. So this is a gaming company. Key franchises include Call of Duty, World of Warcraft, Diablo, Hearthstone, Overwatch, and Candy Crush. So this is a video game company. They produce and market video games. So basically, they're producing software and providing entertainment to people. Now, I know about this company already, so I have some exposure because I've played some of these games. I've played games, so I understand the background a little bit more in depth. But let's dive in first to some key things I'm looking for. So I want beta as low as possible, lower than 1 ideally. So we're at 0.69. That's a good check. Move on. Share turnover, the lower the better. So I want it to be less than 100. 517% is way too high. However, it makes sense that this number is so high right now because they just had a buyout offer from Microsoft. So this company, while currently public, may not be public soon, and the share turnover is likely due to the fact that they just had a buyout from Microsoft, and so the share price is trying to approach whatever the offer price was. So that kind of keys into it. But let's look at the business and look at this business as if it wasn't being bought, because it may not end up being bought. So return on invested capital is what I want. I want to see greater than 10% here, but the higher the better. So I see 8% in 2001, and it fluctuates a little bit, 15, 12, 10, 13. 2006, it drops to 3, and then 6, 20. So there's a lot of fluctuation here. This is not a very stable business prior to, it looks like 2011, but in 2011 you get some stability for a while. 10, 10, 9, 7, 7, 7, 2, 13. So it's still pretty unstable and fluctuating. I don't like the stability here. Even though I would normally think this would be a good business, I'm not seeing it in return on invested capital. So the next check is median returns. In your 10-year median returns, you have return on assets, return on equity, and return on invested capital. Return on assets is 7.6%. I want that to be above 10%. And the higher the better. But 7% is a little low, which means that in order to hit my return on equity target, I'm going to need debt. And I want that return on equity to be about 15% or higher. And right now we're at 11%. So this is a little low, a little less attractive than I'd like to see. So let's talk about valuation. You can work in some of this if the valuation's low enough. Now the PE is 24. This is a high valuation for the company, but again, they just received a buyout offer, and so that is likely increasing the PE here, because normally I would want to buy at a PE of 15 or less. So, but let's analyze it as if that buyout offer wasn't there. So I'd say this is a little bit overvalued. However, if we look at the 10-year CAGR, you see revenue growth 6%, asset growth 5.6%. I like seeing that the revenue is growing faster than assets. That's a good sign here. Meanwhile, EPS is growing at 23% over the last 10 years. So your massive operating leverage here is what I expect to see. So I want to look at gross margins. The more stable your gross margins, the better. Here we have 62%, 65, 66, 65, 66, 63, 64, 66, 67. So what I'm seeing here is very stable gross margins. There's some fluctuation there, but overall indicating a high quality business. You have both high gross margins and stable gross margins. Let's look at the operating margins, 28, 29, 29, 26, 28, 21. So it shrinks here a little in 2016. I don't know what's going on there. But it gets back up to 26, 35 by 2020 and 2019. So overall, pretty good. Meanwhile, your earnings per share is growing from a little under $1 to over $2.82. That's a good growth over that period. Anytime you're growing earnings per share faster than 20%, that's attractive. And they're also paying out a growing dividend over time. I like seeing that. However, I think my biggest problem is that they never really show that they have return on equity high enough to make me feel good about this. You're paying a high price for a company that's not earning enough on its capital to justify it. So the only other thing I want to check is what are they doing with their shares outstanding? You can see that they're buying back shares. You begin at 1.1 million shares, or is this billion? 1.1 billion shares, and it's decreasing over time to 771. So they've bought back shares, or at least they bought back a ton of shares in 2013. There's a jump, and then it kind of grows a little. So I like seeing buybacks. That's a good sign. This discontinuity makes me question it, though. Balance sheet. Let's see what our debt situation is. You have some long-term debt. It looks like $4 billion in debt, $3.6 billion. So it's quite a lot of debt, but you're still mostly being funded by equity, and you have a little bit of leverage there. So again, if we go back to the overview here, I like this business from a theoretical sense of their franchises are strong. I think these are really strong franchises. But I don't understand why their returns aren't matching what my expectations would be. They seem relatively low and not as attractive as I had expected. So I would pass on Activision Blizzard here. The only thing that kind of changes that is that they just received a buyout offer. And so you now have some event-driven investors here, and there might be an opportunity with that. Thank you for listening to this. Don't forget to like this video and subscribe and hit the bell to receive notifications for future videos. Thank you.